Hi, I'm Alvin. I'm CEO of Dr. Wealth, and today I have Brian from Forever Financial Freedom and Alex from Very Proud. And the reason why I got them here today is because they have invested in the Chinese market. And we all know that now the China market has been in a rut and there's a lot of fear. And because they are very invested, they are 70% invested, and myself is also 60% invested in China. So we want to give a little bit of our perspective why we are so much into China, and what are some of the things that you can consider for yourself. But before we do that, I would also want to ask Brian, right, what made you go into the Chinese market in the first place?
Yeah, so for me, for those who've been following my portfolio, I've mostly been invested in the Singapore market for the past a decade or so. And I think it's only since last year that I started looking out overseas. So mainly US and also the Hong Kong or China market. Obviously, China market is very huge. If you look, there's a Morgan Stanley report which says that I think over the past 15 years, they've returned an annual return of about 15%, which is even higher than across all the other regions, including the US. So I thought China was a market that is worth looking into. So I started looking at it since last year.
Okay, so it's like the first overseas market you really invested most of your money in.
Yep.
Can I say that? Yep. Okay. How about Alex?
Similar to Brian, actually, I took the opportunity to go into the Hong Kong and US market when the pandemic hit. So that's when a lot of stocks went rock bottom, right? A very good valuation. So I started getting into stocks like Alibaba, for example, back then. Mainly because China is a very large market, as we all know. It's the only developed country who is recording more than 5-6% GDP growth. So based on that, right, the growth trajectory is going to be ridiculous for the next 10 years. So that's why I looked at China market.
Okay. So basically what they're saying is that they saw the growth in China and believe the growth story, right? And personally, that's also what drew me into China. But I got in earlier compared to Brian and Alex. That was about 2 years ago. I started to look at China, but was more into the A shares, not so much on the big tech in China, more of their very conventional kind of businesses, their F&B, their soy sauce, all these kind of businesses. And it was also only last year where Alibaba first get caught in all these regulatory move, and the share price went down. Then I went into the big tech because I always thought that they were relatively more expensive, and any crashes like this always sounds like a very good opportunity. And I think the concern now is a lot of investors have never faced this kind of regulatory risk, especially when it comes to China, already a pretty unfamiliar market, and there's a lot of fear that's going on, right? And I also want to ask Brian and Alex, how do you see this regulatory risk in China?
Yeah, actually for me, it's still regulatory risk is not something which is new in China. In fact, just in 2017, 2018, they have won quite a big crackdown on regulatory. And then I think before that, even they also have a regulatory crackdown, and even before that, right? So all along, China has been one which has always regulatory risk. But I guess after the post-pandemic, where a lot of people are putting their money into tech stocks in general, both Hong Kong and US, such as that valuation has been pushed very high. And when this regulatory crack comes down into play, it crashed the share price down very heavily, 30-40%, that it kind of spooked the market suddenly.
Okay. And the regulatory risk is not new in China, as what Brian has said, right? But why is the market suddenly so concerned about regulation? Right? Because it has always been happening, like what you said, but why this time round investors are so spooked out?
Yeah, I think because if you look at the past regulatory crackdown, it has always been one or two particular sectors in general. But if you look across the sequence of events happening, starting last year from the NIPO, it just moves from one into another. From fintech, and then you have the anti-monopoly trust, you have the social rights issues, the gaming, and everything else, right, that follows. So I think there's a lot of sentiments around the ground that China is there to kind of crack down each and every industry, and that's where I think a lot of people get kind of spooked by, CCP is going to kind of control the entire China market, which is not exactly the case.
Okay, what do you mean by it's not exactly the case? So you don't think that is the motive of CCP?
Yeah, I mean, it's if you look across the longer term motive of the CCP, right? In the past decade, their goal has always been a China growth first, right? But if you look across the recent papers over the next decade or so, their main goal was actually to grow or still grow, but at a sustainable level. And in order to grow at a sustainable level, it means that you have to take care of all your other so-called more like your other smaller tech companies, as well as all the other social rights and the people in general in China, so that when China grows, everybody wins.
Okay, so you are saying that the government wants to balance the market power, not skew so much the big tech, and
Yep.
and they want that small players to come in and have a space as well.
Yep, that's right.
Okay, which is also considered what US is doing, right? Just that China does it more successfully lah, compared to the
Exactly.
US. Okay, and Alex, so what is your view on all these
Okay,
regulations?
just to add on Brian's point also, I think one of the reasons why everyone is feeling it now, right, is because of the way the actions have come about. Meaning, there's been a lot of actions in the last 1 month, very impactful. So actually, we started back with PingAn Financials in November 2020, right? That one was like one action, and then after that it was quiet for a couple of months. And suddenly we have seen like so many things in the last like one month plus, from Meituan, Tencent a couple of times, Didi itself as well. So it's just that the CCP is able to take action very quickly, and then it's a bit unfortunate that it just keeps coming up. I guess it would have been a lot maybe better for some investors if it comes in piecemeal. In terms of regulatory risk, right, I guess it's also you can split it in a couple of parts, a couple of kind of risks they are trying to mitigate. So things like social issues, things like data security, financial fintech, or the financial industry issues. They have to mitigate all these risks such that the country can slowly grow and grow in the right way. So the way I see it is that they're just trying to build a stronger base, better foundation before they move forward. What I mean by move forward, right? If you look at the China 2025 plan, they've talked about things like AI, automated driving, smart cities. So if they want to go into that kind of segment in the next phase, surely they have to do something now to make sure they consolidate their base properly.
Okay, so what I'm hearing from you guys, right, is that you all still believe that the China story is still intact, right? Still intact. And this regulation is more like to pause a little bit, right, to consolidate, to make things steady before they progress to the next stage of growth.
Yep.
Okay.
Exactly.
Definitely.
And on that note, right, there are some people who believe that that's not the case, right? Obviously, and you look at the internet nowadays, when people talk about China, it's a very divisive kind of topic. It's either people support or people don't support investing in China. There are also people who come and say, yeah, see, I told you don't invest in China, right? All these risks that's coming, and what the Chinese government has been doing has been like realizing people's biggest fear about China.
Yeah.
Right? So what do you have to say to this to counter some of these naysayers about China?
Yeah, I think it's because of the recent crackdown. I think one of the heaviest crackdown was on the education sector. That one kind of just totally killed the entire education private education sector in China, right? I mean, share price are almost down by 80-90%, which is really kind of just push the boundary of an individual investor. I mean, regardless of any investment you are in, if you're down 80-90%, you are like almost given up hope, right? Regardless of what the argument is from the other side. But I think if you really look across a portfolio from an overall portfolio China basis wise, I think some of the arguments are still valid. I mean, in terms of kind of pushing China into the next growth of era, trying to grow and make sustainable growth together, especially like Alex said, gonna go into AI and all these semicon industry and so on. Data privacy and all these things will become even more important, not just in China but in the US as well. So it's something which if the government does not take charge into that right now, it's gonna just go haywire over time.
Okay. So that which means the level of or the degree of trust in China government differs from person to person, right?
Yep.
So then I would ask, why do you have that high level of trust in the Chinese government? Maybe Alex can go first.
Instead of trusting the Chinese government, right? maybe you should trust how the way the world works, so
Okay.
to speak.
Okay.
In the sense that so the big companies like Tencent, Baidu, Alibaba, not only are they consolidating the existing segments, they are also branching out into things like AI. Baidu is into like smart vehicles and automated driving. Tencent is into smart city. Yeah. And Alibaba obviously has a lot of things going on as well, like sharing, community buying, that kind of thing. So these companies, right, they will definitely find ways to grow.
Okay.
Definitely. The reason why I think, right, I'm so vested into China is because like definitely there will be a consumerism. People will spend money, people will buy, and companies will just grow together with the GDP. As long as the whole economy is doing well, these companies will grow. And being a mega tech company with profitability, with a lot of infrastructure ready, they will definitely be in the best position to grow.
Okay. How about Brian? What gives you that confidence in Chinese company when there are so many people say don't invest in China?
Yeah, I think definitely the risk with the regulatory risk, and I mean, if you're investing in overseas, there's always more than one risk that you have to look into, right? More than just regulatory, you have all the other risks that's going on, right? But I think if you really look at the fundamental of the company, which is we know that currently most Chinese stocks are beaten down, and hence they are undervalued by their relative fundamentals. And you look at the alternative, right? So most people are saying that you should not be invested more than 20-25% in China stocks today. But if you look across someone's portfolio, they are like 100% into US, right? And personally, I think US market does has its own risk. Don't want to go too much into the US market, but I mean, if you look across the relative valuation and also relative risk into investing in China stocks today at this price, your risk reward is not much better if you're investing in US stocks, right? You might not get that sort of returns you are seeking out for if you are into the US stocks right now.
Okay. So you are saying that it's not about trusting the Chinese government, but it's about trusting the Chinese enterprises, right? That they are now worth a lot more than their share price is suggesting.
Yep.
And alternatively, there are just not many attractive investment in US have been breaking new highs and new highs. And you don't know whether you're buying near the top, right?
Yeah. And also given I think given that this regulatory risk in China has some sort of history going on, history books that we can sort of relate to, right? So this is not the first time where China just suddenly do a crackdown. It's something they have been doing all along. So I think it's if you play by the history book all along, things are going to come out eventually okay in a couple of years' time. So you have to really like just be confident in the government. Things might still go wrong, but you have to take in that kind of risk versus rewards.
Okay.
I think to add on, what I've noticed is that the Chinese stocks and the American stocks have diverged since the beginning of the trade war in 2018. Right? So now, like Brian mentioned, the US valuations are really lofty, really very high. Companies like Tesla, they need to grow for so many years before they can grow into their valuation. And there are other companies who may never go into their valuation. Of course, they're also undervalued companies. But the China economy as a whole, stock market as a whole, has underperformed. So there may be an opportunity where this divergence shrinks or reduces and valuation catches up. So that will be an opportunity for people who believe in this story.
Okay. And then the next golden question people want to know, right, especially for those that invested in China stock, is when do you think this regulatory risk will at least simmer down?
I think if you look at the first regulatory crackdown, which is the end IPO, right, on fintech, I think it's kind of they kind of sorted it within like 3 to 4 months, and then they gave a fine to Alibaba to kind of settle it, and then things move on from there. Of course, there are other regulatory crackdown on e-commerce, such as the anti-monopoly. People can no longer kind of restrict merchants in order to put in their platform, and a little bit here and there, but I think those are minor, which is not really gonna kind of hit their fundamentals and valuations strictly. So I think eventually this entire regulatory crackdown will move on. Our lives will move on. Their lives will move on, and these businesses which are impacted by the new regulation will comply, and eventually they will transform and move on with the entire new regulation.
So you're saying that it should die down 3 to 4 months later, around that.
Around there. Okay.
What about Alex?
While I wouldn't give a timeline, I would say maybe also about the kind of time frame, but I think more of what to look out for. So these things, they come with like regulatory crackdown first, and then subsequently they may come with like positive news. So maybe things we can look out for in the next few months might be potential acquisitions, mergers, not just globally but locally. That means not just Tencent acquiring someone in the UK, but maybe some local company as well. So if that goes ahead, that's a good sign. Another thing to look out for maybe is the CCP. The CCP might start saying positive things about the tech companies, bringing back the 2025 China plan, where they talk about smart cities again, stuff like that. So then once you can see the kind of theme change, then the government is changing from crackdown, moving to more of supporting these companies for future growth. These kind of crackdowns also tend to occur when the Chinese economy is doing better. So it's kind of counter-cyclical, and we know that the Chinese GDP data and the PMI data are not that great nowadays. So I fully expect China to start stimulus, or maybe cut the reserve rate in a couple of months. So all these things may point to China releasing the stress on this regulatory crackdown. So I think that's what we can look out for. Personally, I really think maybe 3 months to 4 months.
Okay. So you're saying that because of the economic pressure, that the government now has more incentive to lessen that kind of regulatory pressure on the companies. There's also talk in the internet, right, that they're giving the viewpoints that China is doing all this because they don't want their population to starve, the younger generation, right? You've heard of that theme that why they crack down on education because they are studying too hard. Why they crack down on games because they are wasting their time. They should train for ping pong or Olympics or what, right? So there are some thoughts that say that they are moving into because they want to advance their technology, especially their hard tech, right? Hardware technology ahead of US. If you can name one sector, probably it's the semiconductor because they're always behind, and that all the blacklisting is really hurting them quite a lot. So do you buy the argument such that they are regulating all these consumer technology companies?
I think it's more because the consumer tech has evolved a lot faster and better than the hardware tech. Like what you say is right. Semicon is like 2 years behind, and then they don't have things like AI or automated driving yet. So I think what the Chinese government is trying to do is to build a base and then move forward. No doubt they have already declared their intentions to invest a lot more in the hardware tech, and actually we do see the tech companies going into that direction as well. So that's why given time, the big tech will definitely do what the government needs.
Okay, so you're saying they're reining them back a bit, right?
Yeah, in that sense.
Okay.
Yeah, even I think the recent M&A for NVIDIA and ARM, right? There's a lot of behind speculation that the Chinese government is trying to block the entire deal because it's such an important strategic kind of place for them. And in the event the M&A takes place and NVIDIA brings back home, in terms of political wise, US versus the China, it might give US a very big advantage over China in this part of the segment.
Okay. So you think that is a possible reason, right? But that's not the only reason. Okay. And in terms of like your personal bets, if you can review, right, what are some of your biggest position in China?
Go. So I have Tencent and PingAn. Tencent being because valuation is low now. I think PE is about 20, and so Tencent will release their first half results on 18 August. I think what we should look out for is whether they can continue their revenue growth. So what I've seen so far is that Alibaba, who announced a couple of days back, they have like 34% revenue growth. If exclude Sun Art, their acquisition, I think they have 22% organic growth. And a lot of that is coming from all the other segments. So this actually reminds me of how Google used to be as well, where they were focusing on the other segments and were able to push that out. So why I'm into Tencent is also more because firstly valuations. Secondly, they're actually pretty much like people say they are an ETF. They have 600 over investments globally. So even if growth in China slows down, we should expect the growth overseas to continue, especially because that's also in the Western world where it's supposed to be doing better as compared to China in that sense. So that's why I got into Tencent. Also because Brian got into Tencent, I guess everyone got into Tencent, right? So we just joined in. PingAn, I think it's quite easy as in the sense that the current P is about 7. It has fintech, so it has arms like Lufax, arms like One Connect, and of course it has insurance. So I think, if I'm not wrong, China's general population is considered underinsured as compared to other parts of the developed world. They're about half. I think I saw a data saying they're about 4% or something like that. So with time, we would expect that to grow as well. And of course, China being China, when an insurer gets funding or my premium, they can put that to good use and get high returns. So that's why I got into PingAn.
Okay. How about Brian?
Yeah, so for me it's almost similar. I guess the Alibaba is my top positions along with its competitor JD. JD is also because it has a kind of much longer runway growth, and they have a lot of segmental like JD Logistics, JD Health, which kind of propelled them into more future growth. So that's on the e-commerce side. And then the next one will be Tencent. So Tencent is something which I just added like quite a lot since this the recent capitulation. So back then when the regulatory crackdown on Alibaba was first announced, I think Tencent was still pretty high, right? It wasn't really affected. It was still trading above 600, and there was really no much value to kind of look at, right? And it was only like the past 3 weeks when suddenly a lot of gaming regulatory crackdown plus the Tencent WeChat thing sent Tencent into a territory which I think it's very compelling buy. Because if you look across the entire Tencent ecosystem, not only they have the entire WeChat ecosystem that's undervalued, but they also spend their entire free cash flow that they generate every year into new investment businesses. And these new investment businesses are actually worth like easily 2.5 billion on the market cap alone. So if you just add this up, it's just incredible that the market is actually discounting Tencent so much, given what I thought was a pretty minor regulatory crackdown on Tencent's impact.
Okay. So you are saying that the share price have overreacted to the degree of the crackdown.
Yes. There will still be, I think, valuation impact, right? Because Tencent is invested in so many businesses like Meituan, JD, and a lot across all more like Tencent Music and so on, that all this crackdown will have an impact on Tencent's valuation. But if you look across the relative, which means the share price has been hit by so much more, it just doesn't make sense. And I mean, history will tell us that usually the market usually overreacts on news such as like this before it kind of just went back up and then see where the intrinsic value should be at.
Okay. So on that point, right, you mentioned that it has a lot of investment. Some of them got hit by the regulations. But that is very peculiar to Tencent in the sense that because they made so many of these investments, and then the Chinese regulatory risk, right, can be an ongoing problem for them, right? Because, for example, they may move to like Kuaishou, then Kuaishou got hit, then their portfolio get hit.
Yeah, exactly.
They move to Meituan, they get hit as well. They move to, I don't know, Didi as well, they also get hit. Right? So almost any China company, they will get hit. So does that mean that, they will take a longer time to recover?
I think Tencent, I almost look at like as an ETF itself. So if you're buying into the Hong Kong iShares thing, symbol 3067,
Hang Seng Tech.
Hang Seng Tech, right? So it itself, it's almost like the top 30 of Hong Kong tech, which is essential, almost like a Tencent in replacement, right? Which is actually a good and bad thing. A good thing, which is then, of course, all these crackdown on one particular areas will not impact them as much. So I thought it's
Okay. So it's still what you're saying is that the share price maybe dropped 40%, but the valuation of their portfolio probably dropped 20%.
Yeah, something like that.
Right?
Yeah.
Okay.
To add on, I think Tencent is now at valuation is now at the pre-COVID levels. But if you think about what was Tencent pre-COVID and what is Tencent now, because of COVID, right, digitalization has accelerated. The company is no longer what it used to be. It's in a completely different position now, similar to other tech companies. So yet it's still at the pre-COVID low. So this actually presents a huge opportunity to invest.
Okay.
Yeah.
Could it be investors are also seeing that there may be a fundamental impact to their business? Do you see that happening?
I would think that fundamental impact will be short term, most likely. There will be things that Tencent has to do to improve their business and to adhere to government regulations, like how under 12 cannot spend money on games now. This is actually not dissimilar to the Western world, whereby I think Apple also has similar restrictions in the App Store for under 18, right? So all these are just good moves where no doubt in the short term it may impact the revenues and profits, but in the longer term, right, they will find ways to make up for it, and they will find ways to make up for it in good ways, rather than doing things like anti-monopoly or impacting the competition, going after competition. So that's something which I think the Chinese government is doing really well. They are trying to clean this up, and they actually will end up accelerating the growth and the transition of the Chinese companies.
Okay. And Alibaba just announced their results, right? And since Brian has a biggest position in that company, are you happy with the results?
Yeah, I think it's within expectations, right? So like what Alex summarized earlier, it grew by an expected over 30%. Its cloud business is still growing, even though they lost one customers, which I think was TikTok.
Yeah.
But I think overall, if you look across the entire segment, I've also attended the conference call, and the management also gave a very confident and guidance over this regulatory crackdown, right, which they see as a positive news throughout. And also they have been investing all their profits reinvesting back into their incremental business. So all your Taobao deals, your Lazada and so on, they are actually gaining user base, and from the user base they are trying to kind of put people in their entire value chain ecosystem, where people can just spend more and then be there and invite more people, and then just kind of increasing from the angle.
Okay. And besides the regulation, right, there are also increasingly people saying that Alibaba is facing fierce competition. You mentioned JD, which invested in their biggest competitor.
Yep.
Then there's Meituan, there's Pinduoduo, there's a lot more that are coming up, and even Douyin, who wants to get into e-commerce, right? So do you think long-term wise, there's an additional factor to consider, which is competition for Alibaba?
Yeah, I think e-commerce is one factor in China which I thought was facing quite a bit of competition, right? Especially of your JD and your Pinduoduo, right? They are not exactly the same model itself, and even in the recent earnings call, the management also went on to address that by saying that other companies, they obviously didn't mention who, but companies who are actually putting in a lot of advertising spend in order to bring their customers into their competitors' platform. It's not a sustainable way to do business, right? And then if you look across the past 3 to 5 quarters of Alibaba's advertising and spend, they've been constant throughout at about like 8 to 10% of the overall revenue, which means to say, even with the competition, they are not throwing in your deals or your promos in order to get people to come to their Alibaba's platform and buy. I believe they have an ecosystem platform where people know the benefit, merchants know what they can offer, and so people who want to be there is going to get the longer term benefit of the platform itself.
Okay. Then in that case, why do you invest in their biggest competitor as well, JD?
Yeah, so JD is also interesting because JD is spending a lot on its logistic, right? So one thing which I really like about JD, apart from the e-commerce, is their logistics segment. So their logistics segment is today they have 1,000 over warehouses in China. They are still in, I think we're talking about the entire China market share, they only have over 3%. So that's how how segmented is the entire logistics sector in China, right? And also the management has also guided that over the next few years, they're actually going to be reinvesting all of that into more and more their supply chain, their logistics. Now they can send within 24 hours. Maybe even next time they can send it within like 12 hours, 8 hours. We don't know, right? So I thought JD has a lot more runway growth. But if you really think about the entire ecosystem of China with regards to e-commerce, then if China grows, then the entire e-commerce spending will grow at the same time, even though they can be
Which
competing
is
with
part of the government goal of having that dual circulation, right? Not just relying on export, but also
Yes.
internal domestic consumptions.
Yeah, exactly.
Okay. And I know that you guys always discuss about China investment, right? So Brian invested in JD. Have you invested in JD?
I do not have JD at the moment, but I have Alibaba. So I was listening to the conference call that day as well. I think I was really impressed not just by their revenue growth, but also how they have quickly progressed and moved on from Ant Financials. So the Ant Financials issue was in November 2020, and I think in the past few conference calls, they've already indicated their strategic growth plans or how they're going to spend money to get revenue. So I think they were queried on the call by analysts as to what kind of results have they shown. And they've actually delivered significant revenue growth in a lot of segments like Cainiao, like the community buying, cloud as well. Of course, cloud they lost one big customer, but excluding that, I think the revenue growth is also a huge number. So I think while I'm opposite from Brian, where I think that e-commerce is not really the way to go in terms of China now because it's very saturated. You don't have just JD, Baba, but you have smaller companies like Pinduoduo, VIP Shop, or companies like that are also getting different parts of the market. And I think there's also this report that says that they expect e-commerce to grow at only about 5-6% a year for the next 5 years in China. So Baba having the biggest market share may stand to have the most to lose. But their other segments are well offsetting and even covering for the other segments like commerce and financials. I think that shows that the Baba management has done a really good job in the past 6 months, reacted really quickly in terms of recovering from these two other segments that are not performing as well. So I think that's one of the reasons why I still have Baba. JD.com, I view it as a smaller player, which I would love to get into at the right valuation, and also just to need to see them kind of evolve and grow. So they have a lot of segments as well, like JD Health, they have JD Digit, which is not listed, JD Logistics, which is actually I think about IPO valuation now. Like what Brian said, they have only 3% of the market share. But the issue for them is that they are still not profitable or just barely breaking even in a lot of segments. The way they are going to do it is probably to try and take market share or go into smaller cities. That itself is tougher better. So we always know that the big tech always benefits by being first and by controlling everything, which is why we have all these regulatory issues in the first place. But it's kind of a winner-take-all game, so which is why I don't have JD at this point in time.
Okay. How about PingAn? Do you have PingAn?
Yeah, I have a small part of PingAn, a small portion of PingAn. PingAn is one which is more of a very traditional kind of business, right?
Yeah.
If you look about insurance, about the state banks, from a relative valuation point of view, they are always look cheap. So they're always like trading at single P. The dividends are not so bad. You get paid like 3 to 4% while waiting. But again, there are problems within PingAn itself, especially that now they are transforming into more. So PingAn is something which is like it's an insurance company, but going into technology, right?
Yeah.
And it's not the other way around. So the fact that they are incorporating a lot of technology, being an insurance company, they will need more time to transform. They are slowly reducing the number of physical agents through more online screening, online registration, and so on. So the past few quarters results and probably also the next few quarters we're likely to see the results coming down or being weakened slowly. But I think if we look across the longer run, again, China is one player which is going to go into aging population. the entire lower and middle income is going to grow, move up together with the country itself. So I thought PingAn is one proxy which can benefit from the entire CCP's agenda push.
Okay, okay. And all these regulations, pressures, have it changed the way you approach China investments?
Little bit yes and no. Yes, in the sense that knowing all this regulatory risk into play, right? As an investor, if today, for example, Alibaba is trading at a fair value, at a fair value where their intrinsic value should be, with no margin of safety, then probably I will think twice, right? Because you never know that things might go bad like this, like what happened, and suddenly which will send the share price down, like a valuation down by quite a lot, right? But again, if you look across what has already happened, which means that the entire regulatory crackdown on fintech and also on e-commerce have already happened, and that I thought now is a pretty good time to kind of weigh your risk reward in terms of how much further can it still fall, versus how much potential reward can you gain out from this entire crackdown thing.
Which you think it's lopsided?
It's gonna be, yeah, it's definitely way one-sided. Otherwise, we won't be putting a huge chunk of our
Similar to Brian,
funds.
I pretty much only got into Tencent in the last couple of weeks, I think towards the end of July. That's because Tencent fell from like 775 to like 430 now. So obviously it's lopsided, like what Brian has said.
Okay, so the principle of margin of safety is still there. Just that what Brian is saying is that you probably want a bit more, right? Just in case some of these regulatory risks may just come out from nowhere and have a big impact on the share price.
Yeah.
Okay. And probably the last question, right, is that the audience who are listening to us is that they'll be wondering, right? Some of them may be hesitant. Oh, should I go into China? Yeah, it looks like the risk reward ratio is very good. What kind of advice would you give them?
Buy the dip. I think most audiences are fundamental investors, right? So taking the fundamental approach and weighing the risk and reward, we know that there's obviously regulatory risks being present and may continue for a couple more months. But on the other hand, there's so much more that we have talked about in the last couple of minutes, and I think that's why that's what the investors should look at. Of course, if you bought into PingAn at 775, then that's a different ball game where you probably have to wait a lot longer to realize your.
Would you suggest like averaging down?
Definitely at this price. In general rule of thumb is that you need to limit your portfolio investment to a certain percentage for each shares, and then of course general rule of thumb again is that you should average down a certain percentage each time it fails, providing the fundamentals still remains. So like the edutech companies, we are all not sure that the fundamentals still remain because of the fact that they have to go through a transition. We don't know what they will look like in a couple of months. But for companies like Tencent, I don't think we will see it shrinking in the next few months. More likely than not, they probably continue to grow. It might grow in different segments. So like instead of focusing so much on gaming, they might go into cloud, for example. So that kind of dynamic will kind of support the investment thesis from a fundamental perspective.
Okay. How about Brian?
Yeah, so for me as an investors, I feel like we should not try to catch the bottom, right? Because we will never know when the bottom might be. And for investors who manage to catch the bottom, they actually have only probably one very small chunk of their volume of their portfolio, which is not moving the needle in the entire portfolio. So I thought, if you think that the current valuations is good enough for you to make a proper allocation in the portfolio, regardless of how much this is, it can be like 10%, it can be 20%, depending on your comfort and risk appetite. Then I think today's price is something which you can consider. I believe from a fundamental point of view, most of these Chinese tech stocks, people know that their intrinsic value and fundamentals is much higher. They are just really afraid of more regulatory crackdown to come from CCP. And to be honest, we will not know when. No one will know when. And by the time by the time it is so obvious in the papers to the investors' eye that the regulatory crackdown is over, you can bet that the share price will have definitely shoot up way higher than it is today. So I think waiting for that, people call that waiting for things to stabilize. It's not that easy, right? I mean, if you look across the every other event, including COVID-19 last year, it kind of bottomed out on the 23rd of March. We were still in the very peak of the COVID back then, and we won't know that when things are going to stabilize and when things are going to recover.
Okay. So the best opportunity happened when it is scariest, basically.
Pretty much.
Okay, so thank you, Brian and Alex, for sharing their perspective. I hope it gives you a clearer picture of how to approach China and think about your position, your investment. And if you like what we have shared, please like the video and subscribe to our channel. And also visit Brian's blog, okay, Forever Financial Freedom, and Alex's blog, They're Proud. All right, so we'll see you again. Cheers.
Bye.
Thank you.